Welcome to the deep dive. Have you ever wondered why some companies, seem to effortlessly grow and build massive wealth, while others, well, despite looking successful on paper, just don't create that lasting value?
Hmm.
Today, we're really cutting through the noise, the complexity of corporate finance to get to the fundamental truths. How do companies actually create value?
Right.
We're sifting through valuation, measuring and managing the value of companies, a pretty comprehensive source, incredibly insightful, actually, to pull out the most crucial insights.
Yeah, it's a cornerstone text.
Our mission today is basically to demystify company valuation, bust some common myths, and equip you with the knowledge to understand what truly drives a company's success.
Precisely. And the core message from this extensive work, it's deceptively simple but uh, incredibly powerful.
Okay.
Companies genuinely create real economic value for their shareholders
Yeah.
when they consistently invest capital at rates of return that exceed their cost of capital.
The cost of capital. Okay, so that's like the minimum return they need.
Exactly. Think of it as the minimum return a company needs just to satisfy its investors, the financial price of doing business. And this isn't just theory for a few standout businesses. It's a universal truth.
Universal. Okay.
We're going to dig into how companies can apply these principles to genuinely increase value and why they are so genuinely effective.
Okay, let's unpack that core idea then, value creation. The book simplifies it. Value is created by investing cash today to generate more cash in the future. Simple enough.
Seems simple, yeah.
So what are the absolute key elements? What dictates how much value a company actually manages to create?
Right. At its heart, the amount of value a company creates is governed by, two main factors. Its return on invested capital, we call that ROIC, and its revenue growth.
ROIs and growth.
And critically, how long it can sustain both. Here's the critical principle you absolutely need to remember. A company only creates value if its ROIC is greater than its cost of capital.
Only if ROIC is higher.
Yes. And what's often overlooked, and it's quite surprising really, is that growth will only increase a company's value if that ROIC already exceeds the cost of capital.
Wait, so growth can be bad?
If a company grows when its returns are below its cost of capital, it's actually destroying value, not creating it.
Wow. Okay, that's a surprising fact. Definitely throws people off. The book gives this really illuminating example with Lily's Emporium.
Ah, yes, Lily.
Lily and Nate, the
Yeah.
owners, they initially thought, okay, let's just maximize our ROIC percentage. So close down the lower performing stores, right? Get the average up.
That makes intuitive sense on the surface.
But what was the deeper insight they learned? How did they avoid that trap?
The classic misconception, really. The advice they got was to look beyond just the ROIC percentage
Okay.
and consider the combination of ROIC relative to the cost of capital, of course, and the amount of capital they had invested.
The total amount.
Exactly. This brings us to the crucial concept of economic profit. See, even if some stores earned a slightly lower ROIC, as long as that ROIC was still above the cost of capital,
They were still adding value.
they were still contributing value. Closing them might have bumped up the average ROIC, sure, but it would have decreased their overall economic profit.
Which is the spread times the capital.
So initially, yeah, the spread between ROIC and cost of capital multiplied by the invested capital. The real goal, the book emphasizes, is to maximize that total economic profit, not just chase an average percentage.
So if a business is trying to create value, does that mean high return companies and low return companies should actually pursue, well, very different strategies?
Precisely. It sounds counterintuitive for some, maybe, but the data is very clear on this.
Okay.
High ROIC companies, they typically generate more value by focusing on growth. Why? Because they're already earning fantastic returns on every dollar they invest.
Makes sense. More fuel for a good engine.
Exactly. Lower ROIC companies, on the other hand, they often create more value by increasing their ROIC first. Fix the engine before you add more fuel.
Right.
And it's also really important to realize, for most mature companies anyway, simply pushing for faster growth, it rarely fixes a fundamental ROIC problem.
So you can't just grow your way out of trouble.
Not usually. Low returns usually indicate something deeper, a flawed business model, maybe weak execution. You can't just grow your way out of poor returns.
Okay, this is fascinating. And one of the most eye-opening parts of this deep dive for me was how it challenged some, really deeply held beliefs about what truly drives value.
The myths.
Let's dig into a few of those. What about the obsession many managers have with short-term results and earnings per share, EPS? Is that focus truly creating long-term value?
The EPS obsession. It's a huge area of misconception. The authors introduced this concept of the expectations treadmill.
Expectations treadmill. Okay.
If a company is already performing exceptionally well, way above its peers, investors will inevitably bake that expectation right into the share price.
So the bar keeps getting higher.
Exactly. Managers then face immense pressure to achieve what the book calls Herculean feats, just to exceed those already high expectations and drive a higher quidludgem, total shareholder return, or TSR.
Which is the stock price plus dividends.
Right. And what's often overlooked is that much as a company's short-term TSR is actually driven by broader industry trends and, general market movements, not solely by management's direct performance.
So it's hard to pin it just on the CEO.
Makes TSR a pretty difficult metric for, say, direct performance measurement or executive compensation, doesn't it?
Yeah, that makes sense. And what about that relentless focus on hitting quarterly EPS targets? Does massaging the earnings, as they put it, really add value?
No, absolutely not. The evidence is clear. These efforts, often wasted energy, can actually harm the company in the long run.
How so?
Well, while earnings do matter over the long term, not all earnings growth creates value. The market, ultimately, focuses on a company's underlying cash flows, not just its reported accounting earnings.
Cash is king, as they say.
Pretty much. For example, remember when new accounting rules required employee stock options to be expensed?
Vaguely, yeah.
Yeah,
Big deal at the time.
right. Well, companies that had already been voluntarily doing so saw no negative impact on their share price. Why?
The market already knew.
The market had already factored it in. It's looking beyond the accounting gimmicks. Similarly, an acquisition might make EPS look better. We call that accretive.
Accretive EPS, yeah. Sounds good.
But if the ROIC on that acquired business is below the cost of capital, it can actually destroy value, even as the EPS number climbs. Financial markets, they understand this nuance. They don't react positively to acquisitions just because they're EPS accretive.
Okay, so it sounds like if a company announces, say, a big share buyback funded by debt, we shouldn't automatically shear unless we understand the underlying cash flow impact.
You've hit on a key point there.
What about changing a company's capital structure or using what's often called financial engineering? Does that create value on its own?
The book emphasizes the conservation of value principle. Financial engineering, or, simply swapping out debt for equity in a company's capital structure, it doesn't inherently create value.
It doesn't.
Not in and of itself. Value is created only if these actions tangibly increase the size of the cash flow pie.
Increase the pie, not just slice it differently.
Exactly. For instance, strategically taking on more debt can create value if it leads to lower overall taxes because interest payments are tax deductible.
Okay, the tax shield.
Or maybe if having debt encourages more disciplined management decisions that genuinely increase cash flow. But if you can't pinpoint a concrete source of increased cash flow,
Then it's probably just smoke and mirrors.
you're likely looking at an illusion. Yeah, not real value creation.
Got it. Now, many companies pursue diversification or they cross-list their shares on international exchanges, often believing it offers major benefits. What does the evidence from this deep dive really say about that?
This is another surprising myth buster, actually. In developed economies, there's surprisingly no strong evidence that diversification brings benefits, like, say, more stable cash flows or tax advantages.
Really?
No benefit.
In fact, it often leads to significant costs due to added complexity, can even cause business units to underperform compared to more focused peers.
So focus can be better.
It's a bit like deciding to specialize in, I don't know, artisanal omelets instead of trying to open a full buffet. Sometimes focus is actually smarter.
Okay. And cross-listing, listing on the NYSE or London Stock Exchange.
Similarly, for companies in developed markets, cross-listing shares on exchanges like those in the US or UK, it's shown no significant impact on shareholder value.
Now, once you account for differences in ROIC, there's no inherent valuation premium for cross-listed companies. Those perceived benefits, like increased analyst coverage or better access to capital, they just don't seem to materialize in a significant way for these firms.
Wow, okay, so if ROIC and strong cash flows are the true drivers, how do some companies consistently achieve and sustain higher ROICs than others in their industries? What's the secret sauce?
It invariably comes down to competitive advantage.
Competitive advantage, okay.
The book uses a powerful comparison from the dot-com boom. eBay prospered while Webvan went bankrupt.
Right, Webvan, huge flameout.
The core difference wasn't just the idea itself, but the underlying strategies and, crucially, whether they could sustain a superior ROIC. A strong competitive advantage, when it's tailored to the industry structure and how competitors behave, that's precisely what allows a company to generate those high lasting returns.
So what kinds of competitive advantages are there? What do they actually look like in the real world?
Generally, there are two main pathways: price premiums and cost efficiencies.
Price or cost?
Price premiums come from things like genuinely innovative products, superior quality, maybe powerful brand strength, or what we call customer lock-in, where switching costs are really high for the customer.
Like my mobile phone plan sometimes feels.
Ah, could be. Sometimes it's even just rational price discipline within an industry. On the other side, cost efficiencies can arise from economies of scale, accumulated experience, vastly superior processes, or maybe just a better organizational structure.
And the best companies mix them.
Often, yeah. The highest returns often come from weaving together more than one of these advantages.
Can you give us a tangible example, something we can really visualize?
Okay, think about the airline industry.
Mm,
U.S. versus Europe.
okay.
After a wave of consolidation, U.S. airlines have become much more disciplined about adding seat capacity. What does that do? It allows them to operate at more attractive price levels and earn healthier returns on capital.
So fewer empty seats, better prices.
That's a clear example of rational price discipline translating to a price premium. For scale, think of UPS, their vast international network.
It's huge.
Building and maintaining that creates enormous fixed expenses that genuinely deter new competitors from even trying to enter. That's a scale advantage.
Right, a massive barrier.
And for network economies and customer lock-in, well, platforms like Airbnb or Booking.com,
Yeah.
or even software like Microsoft Office, they benefit from the fact that their value to customers actually increases as more people use them. Network effects.
Right. The more people on Airbnb, the better it is for hosts and guests.
Exactly. All while their marginal costs remain very low. That's powerful.
So once a company has a competitive advantage, does it last forever? Is it like set it and forget it?
Not at all. Definitely not. If competitors can easily duplicate an advantage, think self-service kiosks in airlines or robotic automation in manufacturing,
Everyone gets them eventually.
right. Any initial cost improvements are very quickly passed on to consumers as lower prices, and the ROIC doesn't sustainably rise for any one company.
So what does less?
The book highlights that advantages based on things like brand, quality, and scalability tend to have much more staying power than, say, temporary innovations.
Brand quality scale. Okay.
And companies also need to constantly find renewal businesses, new products, often by leveraging those strong brands. Think of Apple's ongoing success with the iPhone after the iPod, right?
Good example.
Or Netflix's brilliant shift from DVD rentals to streaming. That was a huge pivot.
Massive.
What's surprising, though, is that empirical studies show companies have generally been successful in sustaining their high ROIC rates over decades.
Really? Decades?
Yeah, it suggests that effective managers are consistently anticipating and responding to changes better than their competitors. They're staying ahead.
Okay, so we understand the drivers now: ROIC, growth, competitive advantage. How do analysts and managers actually put a number on a company's value? How do they measure all this stuff?
Right, the valuation itself. The book primarily focuses on two techniques that are mathematically equivalent, actually: enterprise discounted cash flow, DCF, and discounted economic profit.
DCF and economic profit.
DCF is widely popular because it directly focuses on the flow of cash. That's what investors ultimately care about, right? Cash.
Makes sense.
Economic profit is particularly insightful because it directly links to economic theory and competitive strategy. It explicitly highlights whether a company is earning its cost of capital.
So it shows if they're beating that hurdle rate.
Precisely. There's also an alternative, adjusted present value, APV, which is recommended when a company's debt-to-value ratio is expected to change significantly over time.
Okay, so a few tools there. When we talk about these models, they hinge on specific financial measures. Can we quickly break down what free cash flow actually means in this context?
Absolutely. Free cash flow, FCF. It's the cash a company's operations generate after it is reinvested back into the business.
Cash after reinvestment.
Yep. It's the cash truly available to all investors, both equity holders and debt holders. And importantly, it's independent of how the company is financed.
Okay.
This is the figure that's typically discounted using the weighted average cost of capital, or WACC.
WACC. That's the blend of debt and equity costs.
Essentially, yeah.
Yeah.
The average cost of all the money a company uses, whether it's from debt or equity.
Got it. And then NOPAT. Net operating profit after taxes. How does that fit in?
NOPAT. It represents the total after-tax operating income generated by the company's invested capital.
Okay, operating income after tax.
Right. Like FCF, it's available to all investors, and crucially, it's independent of the company's capital structure. It strips away the effects of financing to show the core profitability of the operations themselves.
Pure operational profit.
Pretty much.
Finally, what about invested capital? What exactly is that?
Invested capital, it's basically all the long-term money that's been put into the business to run its operations. Doesn't matter if it came from lenders or shareholders.
All the money funding the operations.
That's it. You can calculate it by looking at operating assets minus operating liabilities, or from the financing side as debt plus equity with some adjustments for equivalence. It's the engine of the business, financially speaking.
Okay, the capital driving the NOPAT and FCF. What's the trickiest part of using these models, then, to project future value? Is it just getting lost in the spreadsheet
That's
details?
definitely forecasting. And yes, it's incredibly easy to get lost in the sheer volume of data, the details.
I can imagine.
The book strongly stresses that you can do far more to improve your valuation by rigorously analyzing whether your forecast of future ROIC
The key metric again.
is truly consistent with the company's competitive advantages and the dynamics of its industry. That's a lot more impactful than trying to precisely and likely inaccurately forecast some immaterial line item 10 years down the line.
Focus on the big picture drivers.
Exactly. For cash flows beyond that detailed forecast period, say 5 or 10 years out, we use a continuing value or terminal value formula,
Terminal value, right.
which usually assumes the company reaches some kind of steady state. A common misunderstanding here is that a large continuing value means value creation stops. No, it simply reflects the returns from capital already invested continuing into that future period. It's the value of the business as an ongoing concern.
Gotcha. And what about valuation multiples, like price to earnings ratios, PE ratios? They seem to be everywhere in financial news. Are they a shortcut?
Multiples can be a useful comparative tool, sure, but the source explicitly states they are never a shortcut to a proper valuation.
Never a shortcut. Okay.
The most insightful multiples compare operating value to operating results. Things like net enterprise value to EBITDA, or maybe NOPAT.
So not just PE.
Well, the PE ratio, for instance, is often distorted by a company's capital structure and various non-operating items. It mixes financing and operating results.
Right.
When you use multiples, it's absolutely critical to use forward estimates like expected earnings, not just historical ones. And most importantly, compare a company with a very small, carefully selected sample of peers.
Peers with similar characteristics.
Exactly.
Yeah.
Similar ROIC and growth rates, not just a broad industry average, because that can be meaningless. Any differences in multiples between comparable companies should always be traceable back to underlying differences in growth, ROIC, or maybe the cost of capital.
So multiples are clues, not answers.
It's a good way to put it. Clues that require further investigation.
Okay, shifting gears a bit from evaluation itself to strategic decisions. How do mergers and acquisitions, M&A and divestitures play into this whole value creation picture?
M&A and divestitures.
Okay.
Acquisitions create value when the cash flows of the combined companies are genuinely greater than they would have been separately.
Synergies, right. Cost savings or revenue growth.
Often, yes, through cost or revenue synergies.
Yeah.
However, here's the really surprising twist you often see in the research.
I know.
While acquisitions collectively create value for both buying and selling shareholders in total,
Okay.
empirical research often shows that large acquisitions, on average, actually destroy value for the acquiring company's shareholders.
Destroy value for the buyer.
Because the selling company's shareholders tend to capture most, if not all, of the benefits, often through a high purchase price. The buyer overpays for the expected synergies.
So the seller wins, the buyer often loses.
On average, for large deals, that tends to be the pattern. Successful acquisitions typically involve really clear strategic goals, things like removing excess capacity in an industry, rapidly accelerating market access for key products, maybe exploiting very specific industry scalability, or truly transformational mergers that fundamentally change the buyer's business model.
Needs a strong strategic rationale, not just getting bigger.
Absolutely.
So if acquisitions are often that tricky, what about divestitures? Selling off parts of a company, is that usually seen as a sign of failure or a company in trouble?
Not at all. That's another misconception. Divestitures are a powerful, often overlooked tool for value creation.
Really, selling is good.
It can be very good. The book highlights that companies which systematically review their business portfolios and are willing to shed businesses, even businesses that are performing well, but could perhaps do even better under different ownership.
Like a better strategic fit elsewhere.
Exactly. Those companies achieve higher shareholder returns. The goal here is to enforce discipline in active portfolio management, treating divestitures not as failures, but as shrewd strategic moves to build value by reallocating capital more effectively to higher return opportunities.
So, constantly pruning the portfolio.
Active management, yes.
How can companies then use these value creation principles, ROIC, cash flow, economic profit, to improve their strategic planning and, critically, how they allocate their resources, where the money goes?
Right. Effective strategic management isn't just about, big ideas on a whiteboard. It involves using these analytical tools to guide where money and effort truly go.
Making it concrete.
Companies should identify and really understand their unique value drivers. These are the specific operational and strategic levers that explain their long-term growth and ROIC.
Like what drives customer loyalty or cost efficiency?
Exactly. Things like that. A value driver tree, for instance, is a tool that helps visually link these operational drivers to the financial metrics like ROIC and growth.
Okay, mapping it out.
This allows managers to make explicit, informed trade-offs between, say, short-term performance and the long-term health of the business. It makes those choices clearer.
Instead of just hitting the quarterly number.
Right. And the source suggests that resource allocation decisions should ideally be made for the entire company at once.
Not just within each division.
Preferably not. Ranking and prioritizing investment projects based on their expected return, regardless of which business unit they belong to. It's about fighting those internal silos to find the absolute best opportunities across the whole company.
Put the money where the best return is, period.
That's the idea for maximizing value.
It sounds like a lot of these strategic decisions, though, aren't just about the numbers on the spreadsheet. Human behavior must play a huge role in whether a company actually gets it right.
Oh, absolutely. You're spot on. The human element is huge.
What are some of the common behavioral biases that the book highlights? Things that impact a company's ability to create value?
Yeah, the book dives into this. Two significant biases that come up repeatedly are loss aversion and groupthink.
Loss aversion and groupthink. Okay, loss aversion first.
Loss aversion. Most executives, like most people actually, tend to place a much greater weight on potential economic losses than on equivalent potential gains.
We hate losing more than we like winning.
Pretty much sums it up. This makes them overly risk-averse, causing them to miss out on genuinely value-creating opportunities because they're too focused on the downside.
So they play it too safe.
Often, yes. The solution, as the book points out, is to view investment decisions in terms of their contribution to the overall risk of the enterprise, the whole company portfolio, not just the individual project's risk in isolation. Companies, after all, are designed to take calculated risks. That's how they generate returns.
Right, diversify the risk across the whole company.
And groupthink.
Groupthink. This is when groups of decision makers, they naturally gravitate towards harmony and consensus. They want to get along,
Avoid conflict.
which can prevent an objective examination of all the options and, frankly, lead to genuinely poor decisions because alternatives weren't properly vetted.
Nobody wants to be the skunk at the party.
Exactly. The book stresses the importance of fostering a culture of dissent, where rigorous debate is the norm, not the exception. Healthy conflict over ideas.
How do you do that without making it personal?
Techniques like formally assigning a devil's advocate role for major decisions, or explicitly requiring the team to bring out opposing scenarios or counter-arguments. It helps depersonalize the debate. Focus on the idea, not the person. Makes sense?
And the research cited is compelling. It found that having high-quality debate makes decisions something like 2.3 times more likely to be successful.
Wow, that's significant. And the expectations treadmill we talked about earlier with TSR and market pressure, that's also a behavioral challenge, isn't it? That pressure to perform right now.
It absolutely is. That intense pressure to meet short-term market expectations can tempt managers into those massaging earnings games, or worse, cutting productive long-term investments like R&D or marketing.
Sacrificing the future for the present.
Precisely. Which ultimately undercuts long-term growth and value. It's a classic behavioral trap where immediate incentives and pressures overshadow the courage needed for true, sustainable, long-term value creation.
It takes discipline.
A lot of discipline and conviction. So, this deep dive has truly shown that while company valuation can seem incredibly complex from the outside, maybe even intimidating,
Definitely can feel that way.
the underlying principles are remarkably clear, aren't they? Value creation really hinges on consistently generating robust cash flows.
Cash flow again.
Making sure your return on invested capital, that ROIC, consistently exceeds your cost of capital, and making disciplined strategic choices guided by those insights.
Looking past the noise.
It's about looking beyond just the flashy reported earnings and those short-term metrics to the fundamental economic performance of the business underneath.
So, what does this all mean for you listening? The ultimate challenge, maybe, for any manager or even an investor watching companies,
Hmm.
isn't just understanding these profound principles. It's having the courage and the discipline to actually apply them, especially when facing those intense short-term pressures or, popular misconceptions about what truly drives value.
It's about action, not just knowledge.
Right. So, what stands out to you as the most surprising or impactful insight from this deep dive we've had? Think about how these insights might change the way you view a company's next earnings report, maybe a new product launch, or even a major acquisition announcement you read about. What will you look for now?